Hello, and thank you for joining me for my August 2024 market update. And in today's update, I want to talk about three key things. One being where we at in the market last month and year to date. Number two, what is our market volatility? And last but not least, what's the current situation and some things to think about looking forward. But let's start with a quick summary of what we've seen in July. In July, interest rates began to come down, and that is a good thing for a lot of areas of the economy as well as the market. In fact, Fed Chair Powell said that they're planning to do a 25 basis points rate cut in September. Now, 25 basis points is 1/4%. And they're planning to reduce rates by 25 basis points. He said not more than that, not sooner than that. Now, that could change with the things that are currently going on right now in August around the globe. But that's our current indication from the Fed. They also said that the labor market weakening is the sign of normalization, not a sign of recession. That what they're seeing is that things are just getting back to a more normal place. We're not entering recession. They're still expecting that we're going to have a soft landing. The market began to respond to that by rotating out of some of these areas that have had so much growth, where there's the profit to be taken, and moving into some of the areas that could do better when rates come down. But it's important as we move into August that we realize that we're entering what is seasonally a very weak period in the market. I'll come back to that in a minute, but let's look at where we are year to date. In July, the index that was up the most was the Toronto Stock Exchange. It was up a little bit more than 5.5%. In the US, the Dow Jones had the largest gain, and it's really struggled all year long. So it was up over 4%. The S&P 500 was up just under 1%, and the NASDAQ was actually down 1.6%. But year to date, the NASDAQ is still the highest performer in the US, over 17% gain year to date, followed by the S&P 500 at 15.8%, and then the Dow Jones at almost 8.5%. So it's caught up a bit because of that very strong performance in the month of July. Around the globe, we still have Taiwan at the top, as well as the Amsterdam Exchange. The factors, or areas of the market that performed the best in July were small cap and value. In fact, small cap value was up over 11% for just that month. And that has to do with the fact that interest rates are coming down and this rotation out of the large cap companies that I mentioned. Year to date, however, large cap growth and momentum are still positive. Now, they were negative for the month of July, but they're still positive year to date. And small cap, value, mid cap, these are still underwater year to date. So we'll see if this rotation continues and if that positive return in those other areas continues through the end of the year, and if they might actually end the year positive. In the fixed income area, all areas were up for the month of July. Rates coming down means that bond values will go up, and that is a positive. That's also a reason to shift out of some of the shorter duration into maybe some mid duration or long duration, depending on your plan and your portfolio. But we can see that that could have happened with different areas of the market, that those shifts were being made, and there's a lot of positive areas in those long duration bonds. But year to date, the long duration is still negative. The 10-year, 20-year, 30-year bonds, those long duration bonds, are still underwater year to date. That can change as interest rates come down and they benefit from the increase in the value, as well as have some money that moves into that area. But year to date, the short duration bonds are still positive, as well as some high yield, some preferred stocks, some things like that. But let's turn now to talking about volatility. And I said that this is entering a period of time that is weak for the market. So August, September, October are a weak period of time. And August happens to be one of the most volatile months historically. This chart shows us for each month what is the highest return for that month in the S&P 500, going all the way back to April of 1987 through July of 2024. Then what is the average return and what is the lowest return? So if we look at August, we see represented there by that green diamond, the highest return, 7.01% for any month of August in that time period. The average, slightly under zero. Then the lowest return, where that red square is a negative 14.58%. So the low is almost twice as big as the high. Now, for a lot of other months, those are much closer to each other. And in some months like April and November and December, May and June even, the high is bigger than the potential low. But not so in August. The high is 7.01%, the low a negative 14.5%. That represents the fact that we have a lot of volatility in the month of August. And we can expect a lot of volatility in this August with everything that's going on around the globe. So our current situation is very much like it was when I talked last month. There are 5 key areas to still be monitoring and watching. One is our economic trends. Are we going to actually have a soft landing or enter a recession? The same for around the globe. What is going on around the globe relative to other countries entering recession or staying out of recession? Because that can impact us here in the US. Number 2, are there going to be any policy mistakes? Is the Fed going to move too fast or too slow or too much or too little? And how is that going to impact what's going on in the markets? The markets will react. They'll react fast, and then they'll get over it and move on. But we want to be aware of what these policy decisions are, and are there any mistakes in that? Then we have geopolitical tensions, and I know that you know that those are ramping up. And we have the natural disasters. I know that you're aware of how much more there are right now around not just the U.S., but around the globe. And those have an impact on our supply chains and our communities. And so there's a short-term impact to the market as well, and to companies and to people. And then we have, last but not least, the fact that because of the run-up, there's a lot of companies that are currently overvalued. Now, I would say that we do need to understand that we're entering a period with this AI where the CapEx may be higher historically for a period of time until we move through that. So that's going to impact the valuation some. That happened when we had the internet really get started. And so we're going to move through a period that's a little bit of an adjustment, but still we have some overvaluation. We've had a lot of growth, and there's going to be people taking some profit off of the table in those areas and moving it to potentially some other areas. It's important to understand that even though we're going to have this volatility, there's all this stuff going on, to keep a view on the long term, because the long term continues to move up and the market continues to grow. We want to be aware of if we have a big crisis in the short term, but if it's a normal pullback or the normal type of volatility, that we can handle, because that is to be expected, and that is part of the process of investing for the long term. Now, lower rates are going to be good for a number of areas. Our smaller companies, which tend to have a higher amount of debt, and their debt tends to be at a higher interest rate. So lower rates will take some pressure off of these smaller companies and help them with their cash flow. Then our value-oriented companies, our dividend-paying stock companies, those companies do better if we have a lower rate, partly because their value is based on discounting their future value to today. And when we discount that at a lower rate, that results in a higher value. Our rate-sensitive sectors should do better. Financials, like our banks that need lower rates, utilities, and real estate. We have a number of loans that need to be refinanced in the commercial area, and lower rates is going to be a big help in them getting that done successfully. Lower rates also increase the market breadth. And what I mean by that is that more companies participate in the positive growth of the market. So we have more participation across a broad number of companies and sectors. That's a good thing for all of us as investors because it allows us to invest on a more diversified basis and not give up all of the gain or growth that we are expecting from being invested. We have more of the gain or growth spread out across more companies. That's a good thing. And then our bond values do better as rates come down because they actually increase in value. Now, I want to point out that when the Fed typically cuts rates, and this looks back to some analysis on the Fed cuts rates for the first time and what happens to companies' returns, their growth following that first rate cut. What happens to the small companies, the mid-sized companies, and the large companies? And we see that those small cap companies outperform significantly over the first 3 months following that first rate cut, the first 6 months following that first rate cut, and then the first 12 months following that rate cut. So over that entire time period, those smaller companies are outperforming the mid-sized and the large. Part of that is because a large cap company is not as impacted by rates going up, and so they're not as impacted when those rates come back down. The small companies have more of an impact when rates go up and more of an impact when rates come down. That's something that I want to point out so that you can be thinking about that relative to your portfolio as the Fed starts to cut rates. Now we're in someplace in this market cycle. I believe we're mid-cycle. I don't think that we're at the end of the bull cycle yet, just based on a lot of the underlying numbers. And I don't think that's going to change unless there's a big event that knocks us out of it. But if we're in mid-cycle, then we can see that we need to continue to be invested in more of those large cap, the growth, some mid and small growth. As the economy would move towards recession at some point in time, then we would want to move our investments accordingly. And the market is always thinking ahead of time. So the market is moving before the economy moves. And so that is something that we monitor and watch to see where we at and what might we be thinking as we move forward. So with that, I want to say at this point in time, when I'm looking at client portfolios, I'm looking at how is the portfolio allocated for their short-term, their mid-term, and their long-term allocation. That short-term money is the money that's going to be spent in the next 5 years. That needs to be very stable. Beyond that, we can have some more moderate investments in the midterm, but that money will need to be there when we reach this end of this first 5 years. Then the long term, that's money that we're not going to use for 10 or more years. That can be invested more for growth. That can handle the volatility much better because by the time we get 10 years out, what's going on today will be in the past. So looking at that and adjusting where needed to have that lined up properly. I still prefer U.S. equities over international. I still prefer U.S. large cap companies over small cap, but I would say it could be time to add some small caps as the Fed begins to cut rates. It could also be time to add some cyclical sectors as the Fed begins to cut rates. And then I always review the bond holdings, looking at the quality, the duration, the yield, seeing that lines up, and thinking about, is there any of that fixed income portfolio that is a little bit longer term than the first 5 years that could be allocated to a little longer duration now as the Fed begins to cut rates. So that's a good place to do some review. Always looking at tax loss and tax gain harvesting, seeing what can be done there to keep the tax picture on track for the year. And then continuing to monitor the risk and the volatility. Is this a pullback? Is this seasonal? Is this something else? When we look at bull markets historically, we see that they tend to be longer than we think. They tend to last much longer than this current one has lasted. In fact, if this one ended right now, it would be the shortest bull market since 1949. And so that's another reason I think, just based on the economics, based on history, even though history is never exact, it does give us an idea of what happens. So I think that this bull market has some more room to run before we reach the end of it. This tells us that the average is 61 months, but that's, if we took out a couple of those top ones, the really big ones, I think it would fall more in line with 45 to 50 months, around that range. And so we're still quite a ways away from that period of time as in a bull market. So I hope that that will give you some good food for thought, a good view of where we're at, and some things to think about. If you have any questions, feel free to send me an email, because I do get those and I do respond to them. And I want to say thank you very much for listening, and I look forward to talking to you next month.